why you should have optimism about mortgage rates. A client recently asked me, why did rates go up again when the Fed just recently lowered? And it's a great question. Contrary to what you see on social media when the Fed makes a move, it's not directly about the Fed. It's about the bond market. The truth is they're tied to something that most people don't talk about very often, Treasury yields. And understanding the relationship between the two could actually give you a sneak peek into where mortgage rates might be heading. So this is permission to come nerd out, an invitation to come nerd out with me. So Treasury yields 101. Think of U.S. Treasuries as a government's IOUs, safe investments that set the tone for other types of loans. Their yield is a return that an investor can expect. And most like everything else, when investors buy, yields drop because there's more demand, which equals less return. When they sell, yields rise because there's less demand. So what's the connection between mortgage rates? So rates, as I said before, rates don't follow the Fed directly. They follow the 10-year Treasury yield specifically because mortgage-backed securities, which are bundles of home loans, kind of like mutual funds are for stocks, they compete with U.S. Treasuries for investor money. Those rates, mortgage rates, are returns to those investors. So when yields move, rates move with them. So you've heard the term rising tide raises all boats. Treasury yields are the tide, mortgage rates are the boats. So there's this spread between the two. That gap between the mortgage rates and the 10-year Treasury yield is there because Treasuries are considered somewhat risk-free because they're backed by the U.S. government. And mortgages pay a little more because they're riskier. They're based on you and I paying back our mortgages, which accounts for that increased risk in that spread. Historically, that spread, that gap, has been about 1.7% difference. But the last few years, the spread has been unusually wide, over 3% back in 2023, actually, because of increased risk and uncertainty in the real estate market. That's kept rates higher than we expected them. So how do they move? First way is inflation, which has dominated the news the last couple of years. It's had the biggest impact. When inflation is high, investors want higher yields, so money doesn't lose its value. Higher inflation, higher yields, higher mortgage rates. The second one is Fed policy. So even though I just said rates don't follow it directly, it does have an indirect impact because their monetary policies impact behavior, which impacts where money goes. Third one, economic data. Labor data, stock market upswings and downswings, GDP numbers, all impacts how money flows in and out of these investment vehicles. Fourth one is global events. So turmoil usually brings money into safe havens during periods of upheaval. So that brings yields down. Think of it like a seesaw. One side's for safety when conditions make investors nervous. So money goes into it, pushing yields down. And the other side is confidence, which is when investors sell bonds to put their money elsewhere. So bond yields go up. Rates just sit on whatever side is heavy. So why does any of this matter? Well, mortgage rates historically drop in anticipation of the Fed dropping their rate, which is what just happened in the weeks leading up to the latest Fed rate drop in September. The Fed also announced that they may drop their rate 2 more times here in 2025 due to softening economic conditions. So if that holds true, it's reasonable to expect that mortgage rates may drop ahead of those potential decisions. So it's something to keep an eye on, especially if you're one that tried to time the market. Now keep in mind, this is not a crystal ball. I don't have that kind of magic. I'm just a nerd that study these things. It's just insight on how it works so that you can keep an eye on lead indicators of what makes the mortgage rates move. So you can stay ready for potential shifts because it impacts your buying power. It impacts refinancing options. It also impacts the value of your home. The better understanding you have, the better decisions you can make. So if you ever have any questions about this, want to see how it might affect you or just anything else, please don't hesitate to contact, call or text me. Appreciate you guys nerding out with me. Be great today.